The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Is it possible to be risk on and risk off at the same time? Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld. We're kicking off to the closing bell with some existential questions. Let's try to answer them right now with the S&P 500. Risk off, as Romaine said, you can see the S&P 500 down about 0.3%. We're looking at weekly losses now with this little decline. The NASDAQ 100, we did get back to green briefly on big tech earlier today, but we are since down. A sell-off underway in the bond market. We will keep our eyes on this one. The 10-year Treasury yield higher by about 7 basis points right now. We're back above 440. But if you're looking for the risk on, I found it. It's in the crypto market. Bitcoin is higher right now by about 3.7%, Romaine. We are at a fresh all-time high.
Yeah, the Bitcoin doing great. So are all the other cryptos out there here. But as far as equities, after 2 straight weeks of gains that included 5 record highs in the past 10 sessions, the S&P taking a little bit of a breather as investors do digest the latest developments on tariffs this week and clear their plates for the start of earnings next.
We're at an all-time high or peak in terms of the noise in the markets. If you just think about back to the beginning of the year, our team kind of added around 26, 27 different policy changes or news cycles that really kind of impacted or jolted the markets. Yet the markets have kind of powered through that.
And kind of remarkable, really, given the escalation in trade tensions that actually began on Monday, if you can remember. 25% tariff slap on goods from Japan and South Korea, 2 key sources of components for the U.S. tech sector. And, of course, we end the week with 50% tariffs waived at Brazil, 35% at Canada, 2 key sourcing regions for the automotive sector. In fact, auto stocks as a group headed for a second straight week of losses, while tech hardware stocks barreling toward their first down week in 4. Now, while tariffs are indeed a concern, it's the second order effects that aren't yet. Bank of America strategists say their client feedback suggests no one, quote, no one, is deeply worried about earnings, inflation, or equity valuations. A bet by investors that they can keep chasing this rally in risk assets. Strong money flows this week into technology funds, into financials, and into the Bitcoin.
Into the Bitcoin. I sound like Tom Keene over here. Into Bitcoin, but also into fiat currency as well. We're taking a look at the dollar right now because we managed to string together a weekly gain for the dollar, not by much. We're talking about 0.7%, but you can see we have all these red bars. That's actually the best weekly gain since about March or so, and we are heading closer to earnings season. It officially starts next week, theoretically. We know that the dollar played a starring role last season. It'll be interesting to see how many mentions it gets this time around.
All right, as we kick things off to the close here on this Friday afternoon, Karissa McDonough joins us, fixed income strategist over at Nottingham Trust. All right, Karissa, there's been so much that happened this week, and then almost like, to a certain extent, so little reaction to it. Katie did put up, of course, yields, and we've seen some significant movement in yields, but I am curious if that movement in yields to the upside, at least on a weekly basis, and really the last 2 weeks, is what you expected in the face of everything that happened.
Thanks so much for having me. Yes, there has been some degree of sell-off, but we don't think that the magnitude that we've seen over the last couple of weeks, we're not very concerned in terms of thinking that bond vigilantes are out to just dump treasuries. Something that we've been really pleasantly surprised by over the course of the year, especially since Liberation Day, has been the very kind of resilience in the treasury market. Again, you had this more recent sell-off. I think part of it had to do with the June jobs number and then some of the headlines that we're seeing. But we really see that bond investors are looking through those headlines and they're looking at what we believe is the most important thing, which is, again, we've got an independent Fed, which is making decisions on its own. And that is really the key for kind of the stable functioning of the financial system. And so we feel like this little bit of a sell-off, it isn't really much at all. And treasuries are an excellent opportunity.
All right, I just have to at least poke on something you just said there, the idea of the Fed making independent decisions on its own. Of course, there are a lot of people that are concerned as to whether that will continue. We should point out the Fed has made very clear about the importance of independence and the importance of standing by it. Austin Goolsbee today in an interview with another network also making it clear that the Fed is pushing back on any political pressure. But I am curious, as a fixed income strategist, do you worry at all, given the date of Jay Powell's official tenure being over in May of next year, and all of the speculation right now about who will replace him, that actually maybe exerts a certain degree of pressure that he would rather not have on his shoulders right now?
You know, there's something to be said for being able to look past the headlines and look past the pressure. And I'll say, even if somebody else gets appointed, they are not acting on their own. There are a number of Fed governors out there. As we know, it's a very deliberative body with a whole lot of different opinions, especially now. I think the disparity of opinions within the Fed is as wide as it's been for years. But again, it's not Jerome Powell on its own. And so, again, even if someone else who has a different possible agenda gets appointed, there are plenty of countermeasures to make sure that the Fed is actually focused on its dual mandate. So, no, I'm not concerned about that. And I actually think that the bond investor public seems as though they've looked past that, and they have also come to terms that the Fed will remain independent.
Well, let's talk a little bit about the long end of the yield curve, where there's been a lot of focus recently. If you take a look at the 10-year Treasury yield over the past year or so, it seems like more or less we stay in this range between 4.40 and 4.5% on your benchmark 10-year yield. And it seems like even with all of the different cross currents, it's really hard to leave that range, Karissa. So in your view, what would finally break us out? And would that be to the upside or to the downside?
Excellent question. We have definitely stayed in a range here. I think something that would have to happen for this yield to break up to the upside would be an incredible move up in inflation, which, again, it seems as though we have some comfort level that inflation is going to remain temporary. We wouldn't expect growth to move up substantially. We think that growth is slowing. So we believe that the balance of risk could actually be, for the 10-year to stay stable or move slightly down again. And the reason for that would be a flight to quality. We talked about the supplementary leverage ratio for banks, which could drive demand for long treasuries, but it would really have to be a real fear on inflation for those yields to move up. And we're not of the opinion that that's going to happen anytime soon.
Well, I'm glad you brought up the SLR. It's a good reminder that we do get bank earnings next week. I'm sure that will be a hot topic of discussion. But let's talk a little bit about the credit market, because we're talking about the long end of the Treasury curve. It feels like there's not a lot of love there. There is a lot of interest in credit right now, and you can see that in spreads in both investment grade and high yield, incredibly tight. You also have relatively high yields there. I'm wondering how you're feeling about credit right now when you think about those two different factors.
Well, it's so interesting, all-in yields, because, again, you're getting nice yields in the Treasury market, and you have some degree of term premium kind of supporting the overall yield picture. But credit itself, it is not providing the kind of the protection that you should be demanding for taking on that additional risk. Again, you should have some allocation. It's hard to say I'm not going to be in credit at all. But to the extent that you can reduce exposure, look at long-term spreads, they're at nearly all-time tights. And again, it's that whole kind of waterfall of risk assets. Stocks have gotten relatively expensive. Credit is kind of following that same vein. We do think that there's some additional compensation for financial spreads, but those have even come in pretty strongly since April. So credit's a tough place to be, and we've seen some evidence of weakening in the lower tranches. So we want to keep an eye on that as well.
And it'll be interesting, too, Karissa, to see with the earnings season start, whether that actually changes the dynamics in the credit space and some of those tight spreads we're seeing right now. Karissa, have a wonderful weekend. Karissa McDonough, fixed income strategist at Nottingham Trust, kicking us off to the close here on this Friday afternoon with stocks deeper in the red as we get closer to those bells. One big stock is bucking that trend, Nvidia, at a record high as we speak, leading a rebound in some of the big tech names. We're going to talk to one analyst, though, who's not as enamored on the stock as everyone else, why he sees Nvidia's meteoric rise is maybe running out of steam.
Plus, outside of Nvidia, where else is the money going?
I don't know.
We'll dissect the flows that American Century Investments, one of the country's largest ETF issuers, is seeing with CEO Jonathan Thomas.
And from the institutional investor to the individual investor, a conversation up ahead with your rich BFF. We're going to talk to a former Wall Street trader who turned into a social media star. Vivian, too, joins us a little bit later in the program. Stick with us. This is The Close on Bloomberg.
Well, the big banks are poised to benefit from President Donald Trump's volatility-inducing trade agenda. Analysts predicting that all 6 major U.S. banks will report increased trading revenues in their earnings reports next week. Let's discuss with Bloomberg's Sally Bakewell to set us up. And Sally, I feel like this is always the sort of dynamic that you get the big banks and they always post these dazzling numbers when it comes to trading. But you think about what happened in the second quarter, and it was particularly volatile.
Yeah, I mean, in the second quarter, it was technically when Liberation Day happened. So I think a major theme of these earnings is going to be how the turbulence impacted their earnings throughout the quarter. We saw some stock trading records from JP Morgan and Morgan Stanley in the first quarter. So the question will be is if they can repeat that performance. And we know that Liberation Day spouted this intense bout of business toward the beginning of the quarter, but it did seem to abate as the tariff delay came in. So the question will be, were they able to scale new highs on that?
Well, that's what I'm curious about. So, I mean, because if you just kind of go by what we've seen in markets, I mean, definitely some uptick in deal activity, obviously a lot of volatility in the markets that maybe potentially helps their trading business. What about on the consumer side? For some of these banks that have big exposure to the consumer, are we anticipating to see any real benefit from what occurred in the quarter? And more importantly, are you anticipating that we could see any type of increase in loan loss reserves given economic conditions?
I think we expect loss reserves at the main retail banks like JP Morgan, Bank of America, and Citi to all tick up a little bit. Now, JP Morgan surprised us last quarter by setting aside a lot more than it expected for potential losses. And Citi has already guided us to this quarter. It's setting aside hundreds of millions of dollars more in case of bad loans. So I think what the banks say about charge-offs and delinquencies and their reserve build will be sort of key to give us an insight as to what they think is down the road in terms of the economic health. But banks have to set aside money under accounting rules, so it's always a little bit difficult to parse out how much of that is their view on the economy and how much of that is tied to regulation. But it will definitely be monitoring closely what they say about consumer health.
Also closely monitoring, related to your point, what they plan to do in terms of capital allocation, because between the stress test results and also those SLR changes, it's estimated that these banks have as much as $70 billion of capital to unleash there.
Right. We've had some pretty big regulatory changes recently, or at least proposals, including those to lower the supplementary leverage ratio, which would free up banks to hold more assets like treasuries and increase their ability to spend elsewhere. So we'll be looking for any commentary about what they say about that. We've already had JP Morgan outline a 50 billion share buyback plan. And after the stress test results came out, they all passed and did well. That's the sort of annual health check on the banks. And all of these things, I think, have given them a bit of optimism that they can return more capital to shareholders, do buybacks, and perhaps increase business to riskier types of lending or other products.
Sally, before we let you go, I do want to get your thoughts here on some news that we had across the wire on JP Morgan and the idea that it's telling these fintech companies they're going to have to pay more to access some of the proprietary data that JP Morgan has. You're seeing Block shares move down 4%, PayPal down 6%. A lot of the other fintech companies selling off on this. Why?
Well, this is supposed to be free. The data that banks share, the consumer data that banks share with fintechs, they're supposed to be able to do it for free. Now, fintechs under JP Morgan's plan are going to have to pay a small amount for all the data that they share. This is tied to a pretty controversial rule known as open banking, which was finalized in October, which meant that consumers could download, get all their data for free. Fintechs could use it, and fintechs could, in theory, poach these consumers and steal banks' competition. But the rule, the regulators are trying to vacate the rule under Trump. So JP Morgan, to a degree, in telling fintechs that it might start charging them, is sort of making a statement or betting that the rule will officially be vacated and it will start being able to charge fintechs. But that could really upend the fintech business model. So it's very unclear right now what will ultimately happen, but the fees are supposed to take effect in October, but we could expect a lot of negotiation, a lot of lobbying, maybe even lawsuits before then related to this.
All right, Sally Bakewell helps lead our finance coverage here. You're seeing those fintechs take a leg down. JP Morgan on the back foot too, only by about 0.5%. JP Morgan reports earnings on Tuesday along with Wells Fargo and Citi. The rest of the banking cohorts roll out on Wednesday. And then when we get to Thursday, Katie Greifeld, we start to get some earnings out of non-bank companies, including one of your favorites,
Netflix. Yeah, I'm excited for this one because it feels like the stakes are particularly high for Netflix.
Yeah.
I don't know if you knew this, roommate. I'm sure you follow it very closely. Netflix shares are up about 39% year to date. So really one of this market's bright spots. I know that we're all falling over Nvidia, but Netflix has really been powering ahead.
Well, and it's interesting because Netflix is kind of, at least in the minds of a lot of investors, kind of seen as one of these companies that's kind of immune to tariffs, immune to the economic conditions.
You have to watch TV.
All the noise. Do we? Well, yes, you do.
Yes,
actually.
you do.
Thank you.
Absolutely.
Thank you. And keep watching the close and open interest as we continue to roll on here, counting you down to the closing bells. And we take a look at one of the big stars of the week, and that is Nvidia continuing to climb, continuing to set new record highs. But at least one analyst out there on Wall Street, he thinks, well, maybe this has gone a little bit too far. We're going to talk to the only analyst that rates this stock a sell. That's coming up after the break. This is The Close on Bloomberg. Let's get a view from the sell side. Top calls, big movers on the back of analyst recommendations. And we start off with AMC. 2 thumbs up over at Wedbush, an upgrade to outperform. Some bullishness here that the movie theater chain will benefit from a more consistent movie release schedule, as well as its expansion in Europe. That stock on a 4-day win streak. Next up, Netflix. Needham analyst Laura Martin bumping her price target to one of the highest on the street, impressed not just by the quality of Netflix's content, but by its employee productivity, which she says exceeds its peers, and she calls it a, quote, key asset and upside value driver. Nevertheless, the share is underperforming today and for the past couple of weeks ahead of its earnings, which are next Thursday. And finally, Texas Instruments, a lift to buy over at TD Cowen. The analyst saying the chip maker is well positioned to benefit from an industrial recovery. That stock has now rallied for 7 straight weeks to a record high. And those are some of our top calls. We do stay in the chip space because the only chip stock that's really done better than Texas Instruments over that stretch is Nvidia. The shares at a record high today. This after closing above a $4 trillion market cap yesterday. But among the 79 analyst recommendations out there on the street, there's at least one that is not as enamored with this rally. Jay Goldberg joins us right now. He's an analyst over at Seaport Research Partners. He has a sell rating on the stock and a $100 price target. A price target and a recommendation, Jay, that seem to be predicated on the idea that while Nvidia might be the only game in town for a lot of these high-end chips, that might not necessarily be the case long term. Explain.
Well, I think the issue with Nvidia, it's a good company, but it can't keep growing forever. I mean, if anything, this is an underperform rating. If they've had this incredible run, they make good products, but that's all priced in, right? They've said they're sold out for the year. And once you're sold out, what possible upside is left, right? I think if you look at all the things that can go right, sort of drive further upside, it's a pretty short list. And the number of things that can go wrong is a large and growing list. So they're doing well, but I just think they've gotten so big, I don't see much room for upside this year.
Sounds like, Jay, that it's priced in. All of the good news is priced in, but take us to your negative catalyst list. You say it's a long list of things that could go wrong. What's at the top?
Well, I think there's a lot of little hiccups that are possible in the supply chain. The numbers this year are very much dependent on the ramp of their new product, Blackwell. Blackwell's a great product. It's going to have a big ramp. They're going to have a good quarter, but it's been very painful to get it out. There's lots of growing pains in terms of customer adoption, customer configuration, lots of little pain points throughout the supply chain. And they've worked through most of those, but we still have some ways to go. I think the other big function here is the fact that for the last 2 or 3 years, Nvidia has been selling more than they could make. Like, supply has not been able to keep up with demand. And by the end of this year, all those issues get worked out. The supply is constrained. And what we've seen historically in semiconductors is when you have that change in equilibrium, when demand catches or supply starts to exceed demand, there's always a rocky road and a rocky transition. And I just think, semiconductors are cyclical, and Nvidia's run can't go on forever.
So what do you kind of model in terms of revenue growth? I mean, we had this phenomenal period in last year and at the beginning of the last fiscal year, something like 4 or 5 quarters of triple-digit revenue growth. The last few quarters after that have been kind of 70, 80, 90%. Are we talking about a downshift to what, like 50, 60%, or something significantly lower than that?
I think what will happen is at some point they'll miss a quarter and we'll have to reset numbers. I think that's the most likely scenario, right? Where there's just too much demand, too much supply, more than they can sell. If you look back a year ago, if you're a customer buying Nvidia products and maybe you're taking too long to roll them out, and so you had some excess product, normally you would just tell your vendor, okay, hold off, I don't want to take this quarter's allocation. But if you did that a year ago, there would be a line out the door of other customers who would take your product. That line has basically gone away. And I think there's just there's lots of constraints beyond NVIDIA's control, things like access to power that are sort of slowing down or constraining the data center build out.
Right.
And I just think that's likely to impact numbers at some point.
Also outside of their control is what happens with trade policy, though we know NVIDIA's CEO is on his way to China, heading there next week. Jay, we have just about 30 seconds left with you, but talk to us about the price target, $100. Shares were closer to 106 when you issued that price target. They're in the 160s now. Have you thought about bumping it higher?
Well, we'll see what this quarter looks like. Like I said, I think it's going to be some pretty big numbers. I think that does slow down later this year. I'll revisit my price target as it comes along, but I will say the whole sector has run, and there are other names that I prefer, things like Broadcom, which have actually outperformed NVIDIA since I rolled out on both of them. I have a buy on Broadcom. So I'll take a look at it, but I think we're sic transit gloria, all glory fades, all good things come to an end at some point.
That's true. That's a good place to leave it, too. Jay, really appreciate the time. That is Jay Goldberg, an analyst with Seaport Research Partners. Now, coming up, one of the country's largest ETF issuers on where markets are headed in the second half. American Century CEO Jonathan Thomas. He joins us live next. Don't go anywhere. This is The Close on Bloomberg.
.30 p.m. here in New York. This is the countdown to the close. I'm Romain Bostick.
And I'm Katie Greifeld, joining again on a Friday where, I don't know, we hit a record high yesterday, so that was a little bit more exciting. But
yeah, just take it.
I can't complain too much.
Now, one thing, I'm glad you're here, because
Yes.
I know you do a show called ETF IQ.
I do.
And apparently, there's just like ETFs introduced every day. I've lost track of how many ETFs are out there, but I assume it's like somewhere in the millions now,
Yeah,
right?
it's like a product press. It's crazy.
Yeah. Now, there's some good ones, the ones that we know and love that are legitimate. But there are a lot of other ones. But there are a lot of other ones where I'm just kind of confused as to why they exist.
Yeah, there's like this wild west of ETFs that has developed. There's leveraged single stock ETFs right now. There's altcoin ETFs, which are also leveraged. And it's interesting. The cost to launch an ETF has come way down. So you're seeing all of these upstart firms basically spin up their own ETFs, and in some cases manage billions of dollars with these very small teams who are largely remote. It's the subject of today's Big Take, which is fantastically written, Emily Grafeo and Vildana Heinrich. But it gets into this interesting moral divide, which you and I were talking about a little bit in the break, whether or not these products should exist.
Yeah, and that's what I'm curious about. I mean, it's one thing to create these products, but are consumers buying them up? Are investors buying them up?
Oh yeah, there's big demand. And I mean, there's two worldviews as to whether issuers shoulder some responsibility not to launch products that will probably lose money, but the other worldview is that investors should be able to invest at their own risk. It's their money.
Yeah.
Yeah. Well, let's talk about this with one of the people who's running one of the country's largest ETF businesses. His name is Jonathan Thomas. He's the CEO of American Century Investment, live from the company's annual golf championship in Lake Tahoe. Really appreciate you making the time for us, because that sounds like a lot of fun. And we'll talk about broader markets, but I do want to get your opinion on that. You manage about $76 billion in ETFs, and it doesn't seem like you're too much in those fringes that we were just talking about. What's your take on some of the more high-octane products that have worked their way into the ETF world?
Yeah, it's a great question. So you're absolutely right. ETFs have taken off, and they've really done so at the expense of mutual funds. And so there's a lot of confusion with ETFs. Everybody thinks of them initially as really just passive products, but the products have been launched recently are leveraged, as you guys are saying earlier, or many of them are actively managed. The 76 billion you referenced for us are all actively managed ETFs. And the attraction is they're cheaper to launch. They're less expensive than, in turn, for us to offer from a pricing perspective. They're hugely tax efficient compared to a mutual fund. Mutual funds are great for retirement platforms, 401ks, but there's a lot of inherent advantages in the active ETF. The single stock, the leverage stuff, I mean, those have always been out there in the form of sector ETFs, sector mutual funds, but the ETF space is absolutely exploding in this, what I'll call thematic space.
Yeah, it's wild. If you take a look at the long-term chart of mutual fund flows versus ETF flows, it's almost zero sum. Let's talk about one of your largest products, the Avantis US Small Cap Value ETF. This lists as American Century, but when you take a look at your lineup, what trends do you notice in terms of where the money is actually flowing?
So it's a great question. So yeah, we launched this Avantis brand about 6 years ago. We've already gathered nearly $80 billion in it. And its proposition is a little bit different than what you're talking about earlier. These are highly diversified portfolios that give you exposure to a particular sector. You talked about the small cap product for us, which is in the billions of dollars. And while they're highly diversified, because they are actively managed, you have the opportunity to still outperform the index. And that's a lot of that's very attractive to people. Not that long ago, there was a real desire to have, I'll call it concentrated portfolios, but of course that leads to a wider range of outcomes. And these Avantis portfolios, which have really captured investors' imagination and interest, tend to outperform, but with lower volatility than you would see in a more concentrated portfolio.
Hey, Jonathan, Romain here. I am curious about the differences that you're seeing with regards to customer demand, the differences between the retail side and the institutional side. Are there meaningful differences right now?
There absolutely are. We service 3 different channels. We have a direct-to-consumer channel. We have an intermediary channel sold through great partners like Morgan Stanley, Merrill Lynch, Wells Fargo, and then the institutional side. And what you see, it's interesting. The longest holding folks tend to be the direct-to-consumer with holding periods greater than 10 years. The shortest period tends to be holding periods in the intermediary of 3.5 to 4 years. And in the middle, you have the institutional around 6 or 7 years. Right now, you tend to see a little bit more discipline in the institutional channel in terms of not chasing and really focusing on a more balanced portfolio and maintaining a specific asset allocation. The intermediary channel tends to chase a little bit more, has higher turnover. And we're also seeing on the institutional side a little bit more money moving into non-U.S. developed markets. Obviously, they've had a great run year to date. I think they're probably beating the S&P by 10% or so. But I would never bet against American exceptionalism either at the same time. So it's great to have the diversification. And there are more accommodative policies overseas than we have here in the U.S. But obviously, Trump's trying to make that a little bit different right now with Powell as well here.
So, Jonathan, you wouldn't bet against American exceptionalism, but it seems like a lot of investors might. You take a look at the performance of European markets, for example, versus the U.S. I remember having these conversations in January and February, and people were saying that that rest of world outperformance, it's not sustainable. In July, that conversation sounds a little bit different.
Yeah, it absolutely does. The new administration came into the office, a lot of uncertainty around there. The kind of world order of trading was disrupted with the tariffs we put in place. And it's fun. Everybody talks about tariffs like they're all the same thing. The reality of it is, I look at there's three types of tariffs. There's ones that generate revenue, which is what I think Trump calls the baseline. There's ones to protect industry. We see that with copper and steel and automotive right now. And then there's another form of tariff, which is just a negotiating one to deal with our perceived unfair trade practices and get people to the table so that ultimately we can really deal with just this base tariff level. But yeah, I want, these are short-term issues, and the trick to investing is to be involved in the long term.
Thanks for that, Jonathan. Now that Katie's gotten all the hard-hitting questions out of the way, I have to ask you the question that I really want to know. So you're out there at the American Century Golf Championship, celebrity golf. I don't know if you're actually playing yourself. I wasn't invited to this, but you have a lot of my heroes there. Steph Curry, Jim McMahon, by the way. I'm a huge Bears fan, so give him a shout out to me. I mean, you guys have been a part of this now, and I think you have a contract with them, at least through 2029. Kind of talk about just the importance of this event, because it's more than just, obviously, just watching these celebrities go out there and golf. There's a lot more to it.
There is a lot more to it. So there's two aspects that I think I'd like to bring up. One is the event itself. We raised about $8 million that we've directed to local and national charities as part of the golf tournament. But then overall, American Century Investments is part of our organizational capital structure. We direct over 40% of our profits each and every year to medical research to find cures for cancer and other gene-based diseases. And over the last 25 years, that's amounted to $2.2 billion. So it's a real concentrated effort for us. And this platform, which has just taken off, right? The power of celebrity, the power of social media, and the beauty of Lake Tahoe out here has grown exponentially since I've been involved in over the 20 years. And it's turned out to be a fantastic platform for us to get our story out and tell people what our brand's all about.
And absolutely, and you've done a great job with that, and a lot of the money you've raised for cancer and the awareness it's raised certainly hits close to home for me. Jonathan, really appreciate you taking time for us. We'll let you get back out there. Enjoy yourself out there in Lake Tahoe. That's the CEO of American Century Investments, Jonathan Thomas. When we come back after the break, we're going to talk about jeans. You wear jeans, Katie, right?
Yeah, sometimes.
Okay, well, a lot of people are wearing jeans. Levi Strauss up 12% here on the day. The company's shaking off tariff threats and saying business for right now, it's actually doing pretty good. It's our stock of the hour, and it's up next. This is The Close on Bloomberg. Shares of Levi Strauss rising today, setting up for what is going to be the best week for the stock going back to 2022 after raising its full-year revenue outlook, basically saying that the impact of tariffs not as material as some people had priced into the stock before. Joining us right now is Mary Ross Gilbert with Bloomberg Intelligence. Talk a little bit more about what the company is calling a head-to-toe denim lifestyle that is paying off. Now, I don't know if that's a reference to Justin Timberlake and Britney Spears back in the day when they were walking around in those full denim length outfits, but is that where we're headed? Is that what's boosting the stock today?
Well, actually, I'm not sure that's what's boosting the stock today. I think what's boosting the stock today is that the growth for the Levi Strauss brand looks very strong. And now that we've got Dockers out of the way, essentially that was a $330 million business. So now you've got Levi's about $6.1 billion, and they're saying, hey, we see us getting to about 10 billion. It's a global business. 40% is in the US. So I think the green shoots that came out of the call today is that we're seeing strong traction in women's. Women's is only 38% of the business, and it was up 13% in the quarter. And then when you think about categories, just what you referred to, head to toe dressing, that's what it is. And so it is going to be based on denim, and it's going to be infused with denim. So that means denim dresses, and you have denim tops, but it also includes non-denim, including non-denim bottoms and non-denim tops.
All right, that's a little bit more of my world, because looking at the future and it's all denim is a little bit dark for me. But it wasn't all beer and Skittles. You take a look at the gross margin guide. They did say that they expect lower gross margins due to tariffs, but it seems like there was enough good news that traders are really looking past it.
Yeah, I mean, the hit on tariffs is actually, I think, a lot less than investors thought it might be. And the reason for that is they're only sourcing 1% from China and from Vietnam, which maybe we're going to 20% from 10% baseline. And so for them, they're only sourcing somewhere between 5 to 9% from Vietnam. So they're less impacted, whereas most every other apparel brand has major sourcing coming out of Vietnam, anywhere from 20% all the way up to like 36%. So they're much more diversified. They basically said the tariff hit for them is going to be 50 basis points unmitigated, and then, you know, after mitigation measures, they're in a much better position.
All right, Mary Ross, great roundup. That is Bloomberg's Mary Ross Gilbert. We're driving to the close next with Steve Sosnick. This is the close.
There has been some degree of sell-off, but we don't think that the magnitude that we've seen over the last couple of weeks, we're not very concerned in terms of thinking that bond vigilantes are out to just dump treasuries.
Karissa McDonough kicking us off to the close just about 50 minutes ago. 10 minutes until we get to the closing bells. Katie Greifeld, stocks on the back foot on the day and quite frankly for the week. But of course, that's coming off a phenomenal run off of those April lows.
Yeah, big time. You can see the S&P 500 down 0.3%. I wanted to highlight the Russell 2000, the small caps, again, because this time yesterday they were leading the broader market. That is not the case today. The Russell 2000 down about 1.2%. Wanted to highlight Bitcoin as well because it's risk on. If you take a look at crypto, I was scratching my head as to what crypto is responding to right now. It could be mirroring a move in gold right now. Gold up about 1%.
Yeah, absolutely too. And we get a few bills in the crypto space making its way through Washington next week. We should point out right now too, when we take a look at some of the individual movers out there, Lionsgate, ticker LION, spiked about 9% just a little while ago. The shares are now halted. Bloomberg News reporting that Apollo's Legendary, this is an Apollo-backed company called Legendary, is weighing an acquisition of Lionsgate Studios. Of course, they make a lot of the independent films, and they have a interesting business model, basically low cost in terms of funding what sometimes end up being blockbuster films.
Yeah, it's going to be interesting to see if those shares reopen ahead of the close. I will note that shares are down about 22% since just about May or so. So this is a company that's been hurting.
All right, let's continue to count you down to the closing bells. Steve Sosnick joins us here in Studio 2, Chief Strategist at Interactive Brokers. All right, Steve, this is one of those weird weeks because you have the markets more or less at all-time highs, or at least a lot of the individual names at all-time highs. At the same time, we're still getting hammered by tariff news. There's still a lot of concerns about economic conditions, and we're heading into an earnings season where expectations are relatively low. And I'm wondering if the markets are in sync right now on all of these issues, or are they kind of in conflict with each other?
Well, good afternoon, Ramin.
Yeah.
It's a strange market right now. I think the tariff stuff is actually in some ways easier to unpack. I wrote a piece today where I invoked Dumb and Dumber, where it's like, as long as there's a chance that these tariffs could be pushed back or renegotiated or otherwise ameliorated, the market is going to seize on that. I mean, think about it, 35% on Canada last night. You know, we had we have a little bit of a down day. I'm actually shocked that we haven't managed to make it back to unchanged at any point today, because that's the mentality, is let's look through them, because, and quite frankly, it's worked.
Yeah.
And so as we get into earnings season, as you mentioned, expectations are relatively low. You saw Delta and Levi, Levi Strauss doing well after beating. But Delta, by the way, is after removing guidance in April.
Yeah.
And the stock isn't back to where it was in January. So I think that's reflective. I think coming in, you have a lot more stocks at or near their highs that need to actually say something. They can't get away with saying, we don't know where tariffs are going to be. In April, you could get away with it. Now you can't.
I am curious, though, if you do worry about a sense of complacency. Jamie Dimon, of course, was asked about this at that forum yesterday. This idea that you have market conditions, I should say, that seem almost perfect to a certain extent. Yet we know that what's going on in the world is far from perfect. It's one thing to say, I'm bullish, I think the stock market will manage to work through this. It's another thing to just sit back and just say, I'm not worried at all.
There is actually a huge distinction there, and I think right now we are very much toward the complacent side. As I've been putting it, the half-life of dips has been getting ever shorter, and the reason for that is buy the dip has worked so well for so many people, and the momentum has been so strong that at this point you're getting to where people don't even want to sell, because if you sell, well, then you miss the opportunity to buy the dip. And so that's why you'll notice that you've seen this. The dips are very shallow when they occur. Like today is about as big as you get. And they're generally short term when they do occur. So that so I think that is that mentality of just full steam ahead, and that's usually when you get tripped up. Risky markets. When the market's pricing in a lot of risk, you can improve. Think about, again, April earnings season, where the market was in chaos, and the companies could say almost anything, and the market, they weren't getting punished for it. Now, I think everybody's pricing in good news. It leaves us more susceptible if they don't deliver on that.
Well, how much of this is just seasonality? The fact that it is summer. I hear what you're saying about the half-life getting shorter. There was a great piece out from Near KSAR2 calling this a conviction light stock rally. How much of this is just it's summertime and volume is low and maybe people are tired as well?
Some and some. I'm not a huge believer in seasonality, because if you do believe in it, actually July is a great month, because it tends to be a very strong month, leading to the idea of the summer rally. But then that conflicts with the sell in May and go away. So these things work. They work up to a point. I think seasonality is very fluky. There's some reasons for some of it, but I don't want to get too. Right now the market's moving on other things just besides the calendar.
Yeah, it certainly feels like it, and that's a great point. Sell in May did not work this year, so maybe that takes some water out of the seasonality argument. Let's talk a little bit more about the earnings season to come. It officially kicks off last week, or next week rather, officially, unofficially. You talked about guidance. When it comes to Delta, as you noted, I mean, the full year revenue guide, it was lower than what they gave in January. It was just the fact that they gave guidance at all that seemed to get investors pretty stoked here. Is that the bar? Just saying anything, offering some sort of forecast?
I'm not sure I think the bar is a little higher than that. To be fair to Delta, I think the street had come down to about 535. I don't have the numbers right in front of me. To about 535, and they said we'll be between 5.25 and 6.25. Well, that's a beat off of lowered guidance. On the whole, though, when you have stocks ripping higher, as I mentioned, Delta never got back to its original cruising altitude, but most of these other stocks are flirting with long-term highs. And so as a result, there's got to be some good news priced in, and I think these companies have to be able to offer either clarity or some sort of improved guidance. They can't just punt on guidance anymore, and it's not just a matter of strictly, beating on revenues and your EPS is a necessary condition for a rally, but it's not a sufficient condition for a rally.
Yeah, and of course, this will all start to unfold next week as we start to get those big bangs. Steve, our thanks to Steve Sosnick, Chief Strategist at Interactive Brokers, as we continue to count you down to the closing bells. And, he mentions Delta. I mean, it does raise a question, though. If the expectations are low and you have a CEO or CFO who's confident enough to come in and provide guidance, and that guidance is good, do you end up getting that big pop like Delta got? got or like Levi got today.
Yeah, absolutely. And we'll see if that's the case. I am really interested to see the CEO commentary as well beyond just guidance and see how the tone and mood music changes there.
Yeah, Delta the best performer in the S&P 500 on a weekly basis, followed by Moderna and PTC. To the downside, it's Autodesk. In fact, a lot of software stocks are moving lower on a weekly basis. A little bit of a rotation out of some of those names and into others as we break down all of the days and the week's market action with our global simulcast that starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Katie Greifeld taking you through to the Closing Bell with a global simulcast. We're joined right now by Tim Stenovic in the radio booth, Nora Melinda in today for Carol Master. Welcome to our audiences across all of our Bloomberg platforms, including our partnership with YouTube, Tim Stenovic, on a day where the market decidedly on the back foot, a little bit of a breather from the record run that we've had.
Yeah, a little bit of a breather. We're off our worst levels of the day, but still seeing some red on the screen. Interestingly enough, it's risk on when it comes to crypto. A new record for Bitcoin, up above $118,000 per Bitcoin. So you're not concerned about trade tensions.
Risk on, but we're seeing a market that ended lower. I'm looking at financial stocks being the worst performing sector in the S&P 500 as we close on this Friday.
Yeah, we'll see how that changes next week, though. Of course, we know it's bank earnings kicking off. We have the 6 majors to get through, and it feels like, I mean, you take a look at the sell side, you take a look at investors, they seem to agree that the stars are aligning for financials.
Yeah, the stars are certainly aligning for financials, which, of course, at least as a group, we're trading near those record highs coming in to this week. And don't forget, we also get Netflix as well. So a little bit of a preview maybe onto the consumer side of the equation. And I do wonder about expectations, Tim and Nora, this idea that are investors prepared for the best? Are they prepared for the worst, or are they just kind of somewhere in the middle?
I think they're somewhere in the middle. I mean, look at the expectations a few months ago about what tariffs would do. That really hasn't materialized, and now the commentary seems to be, okay, well, just wait a few more months and we'll see it materialize.
All right, well, we get the closing bells here in New York. A bit of a mixed day and a bit of a mixed week for financial markets, coming off record highs or near record highs, with the Dow Jones Industrial Average closing out the day lower by almost 300 points, or about 0.6%. That's going to amount to a drop on the week of about 1%. The S&P 500 down 21 points on the day, or 0.3%. That's also going to lead to a loss on the week. The NASDAQ Composite and the NASDAQ 100 each losing around 40 points or so on the day, both closing out the week in the red. And there's the Russell 2000, which had been the outperformer for the last few sessions, now the underperformer, down 0.6% for the day.
Decidedly down.
Excuse me, 1.3% on the day. Excuse me.
Oh, that's even worse.
Yeah, even worse.
Oh,
yeah.
Decidedly down day for the major indexes. And look at that, the S&P 500, only 110 stocks in the S&P 500 moved higher today, 390 declined.
All right, let's take a look at the sector level. You did manage to see some green, of course, when it comes to energy, when it comes to consumer discretionary, managing to poke into the green. This is a prettier picture, actually, than when I checked this board at about 9:40 this morning. You had every single sector in the red, but still overwhelmingly financials, healthcare, materials, consumer staples, all dragging this index down.
Okay, I managed to find some gainers today. I want to start with Levi Strauss. Shares higher by 11.3% today. They hit the highest level in more than a year. This after the company came out yesterday and boosted its net revenue forecast for the full year. A big question a lot of investors had was what has been and what will be the impact on the company from tariffs. Harmeet Singh, the company's CFO and Chief Growth Officer, he told our Bloomberg News team that it'll be about $25 to $30 million through the end of the year. We actually had him on our program a few hours ago, and I asked him specifically about moving production, moving manufacturing to the United States, because that is exactly what the president wants to see. It doesn't matter if it's in Vietnam or China or Indonesia or where it is. The president wants to see it here in the U.S. He was decidedly firm in his answer. That is not going to happen for Levi Strauss. He mentioned that 98% of apparel that comes to the United States and that is sold in the United States is actually manufactured outside of the U.S., and they're not going to change that here when it comes to Levi Strauss. Though he's still working through tariffs and even making last-minute changes based on the news that he hears from the president, even up to late last night after earnings, he mentioned. Also, Performance Food Group shares surged higher today. Bloomberg News reported that the company has attracted takeover interest from U.S. Foods Holding Corp. It's a potential deal that would create a food distribution company with a combined sales of roughly $100 billion. This is according to people familiar with the matter. Shares higher by more than 4.8% today. The company would become the #1 U.S. food service distributor with 18% of the $371 billion market. This is according to Bloomberg Intelligence. We should note there is no certainty that these deliberations will lead to transactions, and representatives for U.S. Foods and Performance Food declined to comment. And finally, this is a former micro cap that is now a small cap after today's move of close to 40%. Unusual Machines. It's a drone tech company based in Florida, and drone-related firms rallied today. This after Fox News reported that Defense Secretary Pete Hegseth has issued orders to ramp up production and deployment of drones. Unusual Machines higher today by close to 40%. Josh Sullivan over at Benchmark says the memo focused on 3 main goals: bolstering U.S. drone manufacturing, delivering thousands of low-cost drones to the military, and integrating drone operating into training. Once again, shares higher by close to 40%, Nora.
Well, we've got a few names in the red as expected with the market closing lower today. I'm looking at shares of PayPal. That was the worst performing stock in the S&P 500 today. And we're seeing a lot of other fintech companies like Block and Affirm also falling as well. And that all came after a headline that we saw earlier as we were heading into the close with JP Morgan telling that these fintech companies that they're going to have to pay up for customer data. That could amount to hundreds of millions of dollars for access to customers' bank account information. So we're seeing those fintech companies falling, but also credit card firms like Visa, MasterCard also lower, with the move really threatening to upend specifically the fintech sector's business models. Another stock I'm looking at is Albemarle. That's ticker ALB. $8.3 billion company. It's a lithium producer based in Charlotte, North Carolina, and it was cut to sell from neutral, at UBS, with its price target trimmed to $57 from $64. We have the analyst here encouraging investors to, quote, fade the bounce, as he expects lithium prices will remain lower. And one more stock we have for you, Boyd Gaming, ticker BYD, but not the BYD you're thinking of. It's a casino operator in Las Vegas, Nevada, $6.5 billion in market cap, and it was cut to neutral from positive. They're really pointing to the stock's valuation after selling its 5% ownership in FanDuel to Flutter, and this is all from Susquehanna Financial. They're also citing the renegotiation of its market access agreement.
All right, let's take a quick check in yields here. A little bit of a subdued day, but a lot of activity. When we talk about what happened on the week, a push higher once again across the curve, a second straight week where we see yields move higher, but more importantly is the complexion of that move, a definite slant to the upside, a steepening, a bear steepening of that curve, with most, of course, of the sell-off coming on the longer end of the curve. That 30-year yield up about 8 basis points on the day, and on the week, it's more than 9 basis points higher than where it was last Friday.
What if I told you?
Go on.
Bear with us here. Come on.
What if I told you you could go somewhere and get some really good bagels, some really good pizza, some nice steaks?
Okay, you got my attention.
And it wasn't New York City.
Okay, now you lost me.
I just wouldn't believe you, Tim.
You're not going to say like Jersey or something.
No, we can't do that.
Watch out. Katie's right there.
Yeah, sorry, Joe.
Katie is right there.
I just moved here.
Apparently, London food is having a moment. New York food is having a moment in London. Kate Crater wrote a story for Bloomberg. She covers food all over the world. She's been in London these past few years. And she writes about some restaurants in London that are really serving a lot of food that we focused on here in New York and that New York has become known for. And it's actually really, really good.
We're talking steaks, burgers, martinis. They have apparently got it all over in London. And it's interesting because they're saying that even though it's a high tourist season here in New York, things are a bit quieter than usual. I don't really feel that when I'm walking through these streets at all here, Tim, but apparently that's the case right now.
So, I mean, the idea with this, though, too, I mean, we talk about this idea, and this is just sort of a part of the show where I get to dump on the British.
Please.
Because it's like all their good food, none of their good food is actually British food. It's like, I mean, you get some great New York food, as you just talked about. You get some great Indian food and
food there
South
is so
Asian
good.
food
Amazing.
in there. You get all this great stuff there. What happened to like British food?
It's
just like it's like peas and toast,
the
right?
bangers and mash, the fish and chips. There's some good stuff there, guys.
I remember going to
some local
breakfast in a
food.
local hotel there, and I was
You can get blood sausage. That's not really up my alley, but
Unappetizing.
that's great for these British people who are enjoying New York food. That's
good.
awesome.
And Brexit hasn't affected any of this?
Not that I know of.
Okay.
Wow. Anyway, do you want to talk about airplanes?
Sure. Talk about airplanes.
Okay, let's talk about airplanes. There's an interesting story on the terminal. Delta apparently is stripping engines from new Airbus jets in Europe to use them on grounded planes in the U.S. This is according to Bloomberg reporting. This caught my
What do you mean
eye.
stripping from airplanes? What?
That's exactly what it sounds like.
Yeah, they're stripping the engines off and using them to get those grounded planes up. You might think.
So these are planes they own. This isn't like the guy who comes down down my block to steal like carburetors
in
or
the
whatever.
night.
These are brand new planes.
No.
Okay.
Yeah, brand new planes that they haven't taken delivery of in the U.S. because they don't want to pay the tariffs, but they have this fleet of grounded Airbus A320s that have these Pratt & Whitney engines that have worn out quicker than they were supposed to wear out because of a metal shavings issue.
Oh, go on.
From Pratt & Whitney. So what they're doing is they're taking these engines off, they're throwing them, they're bringing them to the U.S., they're putting them on the planes here. We talked to Sid Phillip about this a little earlier. He said it's actually a pretty easy thing to do.
You could try it at home.
Well, you like the ingenuity there, right? I mean, the idea that, when you run into these issues. Yeah, absolutely. Give them credit there. And the idea that you can just take those and move them on. Why not?
Why not?
Yeah, why not?
Do you know what they're doing with some of the tariff, to get around some of the tariffs too on the planes, right? Did you hear about this?
No.
I was hoping you'd tell me.
The detour, Sid told us they can fly some of the wide bodies to Japan, and then they're considered used aircraft, bring them to the U.S. I mean, Ed Bastian has been very clear that he's not going to pay tariffs on these Airbus planes that are made in Europe. So.
A good workaround.
Yeah, good workaround.
Yeah, until the president finds out about it, but sure.
All right, we got to go. Guys, have a great weekend.
You too.
Happy
It's really,
Friday.
really good to hang up. Happy Friday.
You too, Tim.
Have a good
Nice to
Friday.
see you, Carol, for another third day here.
Nora's here all next week, guys.
Earnings
All right,
season.
let's
Wow.
go.
Wait, Carol's off next week?
Yeah.
Yes, she is.
All right, we got to go. That's going to do it for our cross-platform coverage of the market close on Bloomberg TV, radio, YouTube, and Bloomberg Originals. We'll be back on Monday, same time, same place.
And our coverage continues right here on Bloomberg Television. When we come back, a big focus on the week that was and the week ahead, including a conversation about the state of real estate, particularly in light of a lot of the concerns about tariffs and inflation. Robin Potts, Chief Investment Officer at Canyon Partners. She joins us in just a second. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Katie Greifeld.
And I'm Romaine Bostic. Stocks pretty much ending the day where they started. You do a show in the morning here. So you kind of saw the sentiment coming in today was maybe a little bit subdued. But of course, this is coming off of 2 straight weeks of monster gains in markets. It took not only the broad market to a record high, but of course, a lot of those individual names. The S&P pulling back on the day and on the week. So too are financials, which had been a big driver of the rally that could shift into next week as we start to get those big bank earnings starting on Tuesday, with a big slate coming on Wednesday and Thursday. The VIX remains tamped down, closing out the day below 17, still higher than that 16 level, but well below long-term averages. And Bitcoin continuing to do what Bitcoin does, and that is move higher, go to the moon, another record high.
To the moon and beyond. Let's take a look at some single stocks. It's a Friday, so I thought I'd highlight some of the gainers here. I have to start with Levi Strauss. This is one of the stories of the week, really. Levi reinstating their full-year revenue guidance. They did guide a little bit lower when it comes to gross margin. There are some tariff concerns there. Traders looking right past that. The shares finishing the day up more than 11%. The gains get less impressive as you go on, but we're talking about Amazon up 1.2%. That was your biggest points contributor to the S&P 500 today, and it was Prime Day, Prime Week this week. It was maybe a little bit less impressive compared to years past, but still Amazon ending the day up quite nicely. And Nvidia, I just wanted to highlight this, Romaine, because we know that Nvidia hit $4 trillion in market cap. We're only looking at a gain of about 0.5%, but that is a record close for Nvidia.
All right, as equity markets take a breather, Katie, as President Trump intensifies his trade offensive, there are a lot of people looking to the specific sectors out there and to see and maybe discern how they're going to perform. Real estate, of course, is one of those sectors. It's had a little bit of a challenge over the past month as investors navigate the lingering uncertainty. However, our next guest does see compelling opportunities out there, particularly in the multifamily and student housing space, as well as in the Sun Belt region. Let's bring Robin Potts into this conversation. She's the CIO over at Canyon Partners of Real Estate. And Robin, I mean, I know you are kind of in that position where you're always on the lookout for opportunity. But when you see the type of, I guess, uncertainty, for lack of a better word, or volatility, maybe a better phrase, with regards to where policies are going and how it might actually affect interest rates and economic activity. Does that give you pause at all?
You really have to pick your spots in today's market. To your point, there are a lot of uncertainties that the macroeconomy is dealing with right now. And as you mentioned at the outset, one of the areas that we find opportunity in is in the rental housing sector. The overall affordability of the single-family sector is so challenged that it's really underpinning the fundamentals within rental housing. You've also seen, from a supply perspective, a huge pullback in new construction activity within rental housing. So we're going to start to see a 50% drop-off in supply as you look forward over the coming years. So it's really both a demand fundamental perspective that we think is quite positive, as well as looking out over the medium term, a pullback on the supply front.
Do you see the ability for builders to actually build in this environment? And I ask that more so because we've talked with several of those folks over the last, and these are mainly residential builders, this idea that there has been a little bit of concern about the direction of interest rates, the direction of housing affordability, and that's affecting their long-term models as to determining what to build, where to build, and how much to spend on it.
It's incredibly hard to get new construction done today for all of those reasons, and the renewed kind of challenges with tariffs make that even harder to pencil right now. So you have heightened construction costs, you have heightened financing costs, and it is more challenging to get construction financing today. And that's why, as I was mentioning, when you look out at the new supply coming out over the next 2 to 3 years, it's very muted. As a result, developers have had to really evaluate their pipeline and what can pencil to actually move forward on.
Yeah, well, that's the thing, right, Robin? It's not just interest rates. It's also the raw cost of building materials is going higher with all of these tariffs as well. But I want to talk about the state of commercial real estate a little bit, because it's become a little bit of a mantra over the past couple of years. Commercial real estate, a lot of opportunities there, except for office. How do you think about offices?
The office sector is quite challenged. I would say there are some green shoots that we're starting to see that hopefully will set the sector on a better trajectory. But within the office space, you really have a have and have not situation where the higher quality, recently built, well-leased assets are seeing investor demand. And you've also seen financing come back for those assets, whereas a year ago it was much harder to get an office asset financed. So that, as a result, you've seen investors underpin demand for the higher assets. You've started to see those trade. Valuations really bottomed for office last year and have started to turn the corner. The Class B and C older assets in inferior locations, though, those continue to have both leasing challenges as well as investor appetite challenges.
All right, so higher quality in office, maybe okay, have and have not, as you put it there. Let's talk about where you are finding opportunity. When it comes to commercial real estate, where are you picking and choosing right now?
So I would say there are, 2 areas of opportunity that we're quite focused on. The first is in this higher for longer environment. Real estate debt is a clear outperformer in this environment. You have the ability to, provide capital solutions to owners and operators and developers at attractive yields in today's market, earn current income, and in many cases have the opportunity to earn yields that are superior to ultimately what the equity can offer. So that's an area where, as a result of the bank pullback, there's a persistent opportunity for alternative lenders to step in. I would say the second area of focus for us has been as a result of the fact that you've had such a shift in real estate valuations over the last 3 years based on the rise in interest rates. There are maturing debt issues. There are owners that are underwater in their equity. And that creates a need for opportunistic capital to step in and fill gaps within the capital stack and solve capital needs because the refinancing debt is lower than the debt that they have. And it also provides opportunities to step in and acquire assets at an interesting reset valuation price point today.
All right. Robin, have to leave it there. Great to spend some time with you on this Friday. That is Robin Potts. She is Chief Investment Officer of Canyon Partners Real Estate.
We do have some breaking news, Katie. This on the company NIQ Global Intelligence. This is the former market research unit of Nielsen. They filed to go for an IPO at the end of last month. We're now learning, based on Bloomberg reporting, that they do plan to begin marketing that IPO as soon as next week. It's estimated that this would be a $1 billion offering, valuing the company at around $10 billion. At that level, this would make this one of the bigger IPOs of the year so far, Katie.
Yeah, it's interesting. We haven't seen a summer slump when it comes to the IPO market. We'll keep our eyes out for that one. But coming up next on The Close, investor pressure mounting as Tesla finally sets a date for its annual shareholder meeting. We'll discuss next with Charles Elson of the University of Delaware. This is The Close on Bloomberg. Tesla finally setting a date for its annual meeting in November. This as investor calls ramp up for increased board accountability and transparency. Joining us to discuss, I'm pleased to say, we have Charles Elson. He is founding director of the Weinberg Center for Corporate Governance at the University of Delaware. Professor, it's great to have you with us. I absolutely want to talk about the board, but let's just first talk about the delay to the annual meeting. In the end, there were investors really urging the company to set this meeting date so that it wouldn't violate Texas law. What do you make of the whole kerfuffle?
Well, an annual meeting is just that. It's annual. And it's a fundamental part of owning stock that you get once a year to elect your directors. And, think of it this way. What if the Texas legislature said, well, gee, we're not going to have an election this year. We'll postpone it by a couple of months. Because why? Because we want to. The point is that it's a fundamental aspect of owning a share of stock that you get to vote on your directors, and you do it annually. And the fact that they would push a meeting off, even into November, which is way beyond, the annual basis, if you think about it. Annual means 12 months. Now, states like Delaware, Texas, you have 13 months. That's fine. But this goes way beyond that without any reason. And that's the real problem, or at least any articulated reason. Sometimes companies are allowed to go beyond a year, but there are very specific reasons for doing it. And courts are very tough on that particular issue because that's a fundamental shareholder right. And obviously, it didn't happen here.
Would you anticipate that the Texas courts would be tough on this issue? We know that Tesla moved their incorporation to Texas for a reason.
Yeah, that's a good question. I mean, they're there, and obviously it's a large hometown company, and that's probably one of the reasons they went there. They know they get support. Delaware was always viewed as very neutral. It didn't matter who you are, what you were, that they applied the law neutrally, evenly, and I believe for years fairly. Now, Texas, I would hope the judges would interpret the law appropriately, that a year means a year. But again, who knows? I don't know what their argument would be, and I don't know if a shareholder would even be able to bring a suit because of the way Texas law changed vis-a-vis allowing only 3% shareholders or above to bring derivative suits. So who knows?
I am curious. I mean, you sit in Delaware, which for all intents and purposes is basically the seat of corporate America in one way or the other. But as you start to see more companies sort of look to Texas or Nevada, basically try to find some alternative, I do wonder if the Delaware courts and the Delaware legislature is actually looking to rectify or at least address maybe some of the concerns that have prompted some of these companies to look for greener pastures.
Well, the concern really has to do with a controlling shareholder who wants to basically do what they want to do. And the Delaware courts have always been careful on that yes, as long as it's in the company's interest, but if it's in your personal interest and it affects the value of everyone else's stock, then no, you can't do that. And I think that's the problem of being a controller. I mean, typically, you want to run it your way. The problem is once you take public capital, the world changes for you. In other words, you're suddenly in trust with other people's money. And at that point, the rules change. And I think one has to recognize that. And I think some controllers are unwilling to. And that's really the bottom line. If Delaware changes, we'll see. I hope it doesn't.
But Charles, where is the enforcement? And I mean that because it's easy to say, oh, okay, they're going to delay this meeting until November. I mean, the fact of the matter, it should have happened this week or by the end of this week. And I am just curious as if there's no real enforcement mechanism, then why does Musk or the board even need to abide by these dates?
Well, that's the problem. That's, historically, a shareholder could go into court in Delaware and say, look, you need to hold a meeting. And that has happened where companies have delayed. Shareholder appears and says, force them to do it. And Delaware has a court of equity who will say, you have to have the meeting. Texas, I don't know. I mean, because of the limitation on the ability of shareholders to bring actions, it's unclear who could. Texas isn't going to. And certainly Mr. Musk isn't going to. So that's the real problem. And I think that's why, to me at least, remaining in Delaware was the right thing to do. My concern is that Delaware, to appease these folks, changed its law to make it more favorable to them, but harmed everyone else. Delaware protects capital. And when you shift to not, this sort of happens. It's called a race to the bottom.
All right, Professor, we have to leave it there. Always a great conversation. Charles Elson, founding director of the Weinberg Center at the University of Delaware. This is Bloomberg. The workforce at NASA, the U.S. space agency, has been under pressure. Politico reports that at least 2,000 senior staff members plan to leave the agency. It's raising a lot of questions about the U.S.'s commitment to some of the premier government scientific programs out there. Danielle Wood is associate professor at the MIT Media Lab, and she warns that if those folks leave suddenly, she is concerned about training future leaders at NASA. Danielle, who has held positions within that agency, she joins us right now. Danielle, great to see you again. I wish it was under slightly better circumstances, but I do want to start off with this report about the potential for more than 2,000 of folks at NASA to leave the agency. That's a huge number. And I am curious as to what would become of an agency if all of those folks suddenly left all at once.
It's a really important question. I think we want to start by reminding the audience of what people at NASA actually do. NASA typically has about 17,000 government employees, but they work alongside many more people who are from the private sector. And they're at sites all over the country in states like Maryland, Texas, Mississippi, Louisiana, California, and Florida. And these engineers and scientists and managers, they're developing new technology to help us understand the Earth, monitor hurricanes, study how the sun affects our planet, and thinking about the next generation of technology taking us to the moon and Mars and understanding our solar system better. So they're working really hard, and it is a major change, especially if we think that many of the seasoned, well-trained leaders at NASA are suddenly leaving without a plan for the next generation to be trained. It takes a long time to become a NASA scientist and engineering leader. And it's taken me about 25 years to go from a NASA intern in high school to somebody who's now able to lead projects funded by NASA. And I think it's really important that we plan succession as part of our national science strategies.
How do you attempt to do that right now, Danielle? And I'm glad you bring up the expertise. Based on the Politico report, most of these people would fall into the higher tier categories, at least in terms of pay, which would basically raise the presumption that these are much more seasoned and experienced scientists and administrators. So once you lose those folks and you don't necessarily have a pipeline to replace them, how do you repair that?
It's definitely important to emphasize this, that the type of people who have voluntarily said they're leaving because of the kinds of pressures that are on the agency now are people that have grown in their careers and really demonstrate a lot of accomplishments. I see from firsthand experience that these are leaders who have either led research science teams, they've been responsible for multi-million-dollar budgets. They're really important people. And typically this is done, the growth of those careers is done through a long-term process of supporting their education at the undergraduate and graduate level, people working as mentees and teams and learning from the most experienced people. Yeah. And just to say that our country's been doing this for 80 years, investing heavily in science and technology at all levels, from education at the high school to college to graduate level and professional. And we must keep doing this to maintain our international competitive edge.
Well, absolutely. And we know that government programs and, of course, the partnerships the government has had with universities have led to huge breakthroughs, whether it was the Apollo program, the Human Genome Project, obviously the Manhattan Project, for other reasons. But there is an argument out there, Danielle, about this idea that the private sector is starting to pick up more of these tasks. You're certainly seeing that with regards to space and satellite launches and things like that. And I am curious if that is complementary to the sort of holistic nature of what we're trying to do as a country, or does it work against it?
There's actually some really great balance happening now between the private sector and the government sector. They have two different jobs. Often the government sector should do things that are really for the safety of society, helping support disaster response and making sure that we have public services in areas like transportation and energy. And the private sector can often provide things that might be delivered to individual businesses or people, but they often build on the infrastructure and the scientific knowledge and expertise from the government research and technology. Technology always matures from the lab into use, but we can't take away the technology development phase and just leave the private sector to do things on their own. We want to see a synergy between public and private partnership. We're seeing really creative examples today. NASA is supporting researchers to use newly available commercial data to do really important novel things. So we need both sides, public and private.
You sit at MIT, obviously one of the most prestigious universities in the world, particularly when it comes to sort of pumping out future scientists. And I am curious as to when you look at the students on that campus and even some of the faculty, the younger faculty, I mean, what gives you the most hope in terms of where these people are going to put their efforts, what they're learning, and more importantly, where they're going to put what they learn to use once they do go out there into the workforce?
It's wonderful to talk about students. That is definitely what gives me hope every day. The students of this generation, they have high standards for what the future looks like. They believe heavily in a more equitable society. They want to protect the planet and ensure that we're safe and for future generations. They also want to make sure that the things we invest our time in are good for today, but also good for the long term. And they also see a need to work across boundaries of race and gender and ethnicity. They see that there's a need to collaborate across these different boundaries. So I'm very excited about today's students.
And just one final question, Danielle, and this is really about the space race that we've been seeing kind of led by the private sector. Obviously, with the advent of SpaceX and their domination right now and satellite and rocket launches, and obviously you're seeing a lot of other companies really try to step up their game here. Do you think we're going to start to see, maybe soon, real big advancements in space or exploration the same way that, at least for those of us who are old enough to remember, saw in the 60s, 70s, and even into the 80s?
I think we are in a very exciting time of space, and I'll just add that it's global. I just came back from traveling in Nigeria, Angola, and South Africa. I was celebrating recently with leaders across Africa, the new African Space Agency. So there's definitely exciting innovation happening on every continent right now in the space sector. And yeah, we're going to see a lot of creative benefits, and a lot will come right home. We're going to address invasive plants and issues around mining and issues around how we use technology to take care of our planet. Plus, we're going to see new things like manufacturing in space and people living on the moon. It's going to be exciting.
All right, Danielle, and I'm sure you'll be a big part of that. Really appreciate you taking time for us, as always. Danielle Wood, their associate professor at the MIT Media Lab, who's done a ton of work in the world of space and, of course, formerly spent some time at NASA. All right, let's take a quick look at how markets closed out the day and on the week. It was red arrows to the downside for the major markets, despite some big green arrows to the upside, including record highs for Nvidia, Microsoft, and Oracle on the week. And that is the setup heading into a very consequential earnings season, with folks decidedly focused on the impact of tariffs on the economy and the idea that so far we have not seen a huge impact on the bottom line. You see the VIX tamped down here for another straight week, and the dollar index getting a modest bid on the day, though somewhat kept in check on a weekly basis. This is the close on Bloomberg. Time now for our top three. We name drop the people driving some of the day's most talked about stories. And we start off with Amancio Ortega, Zara's billionaire founder, buying a hotel, as billionaire founders do. A hotel in Paris, spending $113 million on that. His second property purchase in the French city in the past year, but he's not stopping there. He also recently purchased an apartment building in Florida, Fort Lauderdale, for almost $200 million. Another person that we're keeping an eye on is the world #1 ranked tennis player, Jannik Sinner, cruising into the Wimbledon men's final earlier today after beating 24-time Grand Slam champion Novak Djokovic, the 23-year-old Italian tennis star, set to face off against Carlo Alcaraz in the title match. And last but not least, we got to mention it, Justin Bieber releasing a surprise 21-track album earlier today titled Swag that my producer has been listening to all day instead of working. She calls it one of the most personal albums to date, with the singer addressing everything from his marriage to mental health struggles. It's his 7th album and comes 4 years after his last, Justice. All right, another person we're watching, and someone that I'm sure you know, is your rich BFF. It's former Wall Street trader Vivian, too, who has built a social media following in the millions in her mission to help younger generations with financial literacy. And I'm pleased to say that Vivian joins us here in Studio 2 right now. Great to have you here.
Thank you so much for having me.
This has to be a weird time because it's like when you talk about this idea of sort of learning where to invest, learning where to put your money, it's a lot easier to do that when times are stable.
Yeah.
There's not a lot of volatility, not a lot of chaos. All we've had over the last 6 months is volatility and chaos. So I'm wondering like how you, if at all, adjust your message, or do you not?
I don't. I actually recommend everybody stay the course. Slow and steady wins the race. Don't try to day trade or swing trade or pick the perfect investment or try to time the market, because guess what? Most people aren't going to be able to get it right. But being able to dollar cost average into the market, diversified portfolio over 40 years, it's almost impossible to lose money, right? You want to be really mindful about what you're investing in. And I think about it similarly to how I order dinner every night. If I'm thinking, oh, maybe Chinese food, maybe sushi, maybe Mediterranean, you don't know what you're doing. You're frozen by paralysis. You are trying to analyze everything. But guess what? If you just think about, hey, if I had this last night and this the night before that, this is what's going to make sense for me to have tonight. It's slow and steady, and you can pick something delicious all the time.
So I like that, and that's a lot, and that's long term, right?
Yes.
I mean, on the show, I mean, look, we got to get criticized because we're like every day we're talking about the markets.
Of course.
Markets go up, markets go down on a day-to-day basis. People don't necessarily invest like that. You're thinking in terms of months and years, in some cases even decades. However, the short-term stuff shapes the long-term narrative. And right now, the short-term is decidedly about policies coming out of Washington. When you see a big tax bill like that just got signed last weekend by the president, does that translate into the types of investment decisions that your followers are going to have to make over the next few months, years, and decades?
Absolutely. I think that's always going to be something that we have to consider, right? During times of economic uncertainty, we know that consumer staples typically outperform discretionary brands, more entertainment, more fun stuff. And I encourage people to also think about that when they're thinking about investing in their own careers. So if you have a career in an industry that may have some troubles over the next couple of years, keep an eye out on, those LinkedIn recruiters. If you are in something that's a little bit more stable, maybe think twice before job jumping. All of the advice that we normally give people of, every 2 years you should be up or out and finding a new opportunity to pay you more, that kind of goes out the window when there's all of this uncertainty. It's very hard for people to make decisions about their careers, about what they're going to do with their money, and more so if they want to start businesses.
They keep showing this video of you holding up this Christian Dior bag. and the problem is I have no context for it. And yesterday we were all talking about, I don't know if you saw this Birkin bag that's sold for like $10 million. Great investment for Catherine B, who got it a few years back. But what's the message you're sending there when you're talking about how you spend your money? And obviously we all like nice things, like our designer clothes and bags and things.
I'm very much someone who believes you should be able to have it all. You should be able to spend your money mindfully, but still set aside in your budget for things that you really want. That video specifically was talking about how if you already had intentions of purchasing a designer piece, oftentimes buying it in a foreign jurisdiction, like the EU, maybe Japan, maybe whatever, you can likely get a refund on the value-added tax that you're paying there. So it'll actually be cheaper with the exchange rate, with some of the import duties that you may now need to pay. It just makes more sense to buy mindfully if you were going to buy that bag anyway. I'm not saying you can't buy it. I'm not saying you should. But if you're going to, you might as well save a couple bucks.
I like that idea. Do you look at it, or should people look at that as an investment? The idea that if you are splurging on something like that, or no, you shake your head, so just enjoy it? And
here's my thing. There are certain pieces that are true investment pieces. And I'm talking if you can get like a royal oak, something really, really special, a Nautilus, Patek Philippe at the original market sale retail value from the from the actual store.
Yeah.
That is going to appreciate in value. A Birkin bag, some of the more coveted, the Himalayan croc skin, sure, those are investment pieces. But most designer does not appreciate in value. And frankly, over time, we've actually seen some of these designer brands kind of pull back on that ultra high quality leather or that ultra high quality craftsmanship. So my thing is, if you want a designer piece, you can get it, but just enjoy it.
There are a lot of folks who are investing or are looking well beyond traditional markets, or beyond the public markets, even beyond private capital. And they look to things like collectibles. Obviously, crypto has sort of become the ultimate alternative asset. Like, what in that space do you advocate for?
You know, I think any of it can be a part of a healthy portfolio. That said, when it comes to things like novelty items or collectibles, what I like to say is it's only worth what somebody's willing to pay for it. I mean, I'm someone who personally used to flip sneakers, like Jordans, Yeezys, but that's because other people in the market were willing to pay more for them. That said, if you are buying collectibles and one day the Labubu is no longer hot, no one's paying you $150,000 for that Labubu anymore. So I think that is my thought on collectibles. When it comes to crypto, I always say investing in crypto, you want to make sure it actually has utility. Things like Bitcoin, you can go and buy a pizza. You can go and buy a watch. You can go and buy stuff. You can use it. Some of those Coachella NFTs actually got you lifetime access to the concert, which is something you would have paid cash for. But then there's some meme coins out there. I'm like, what are you doing with this? Like, what is the inherent value?
And we saw the collapse in
of course.
NFTs and
I mean,
meme coins. And
none of it worked out. So.
Yeah, and you're talking to a guy who just overpaid for a bunch of Labubus.
Yeah.
It's a good way. So I'm sure that'll blow up in my face. Vivian, this was great. We got to get you back, talk longer. Vivian, too, you can check her out everywhere. She is the founder and CEO of Your Rich BFF and a New York Times best-selling author. We'll be back in a moment. This is Bloomberg. All right, wine partnerships are bubbling up in professional sports. The WNBA, the latest to bite, announcing a new partnership between the Golden State Valkyries and J Vineyards and Winery. We spoke earlier about that partnership with Women's Basketball Hall of Famer Sue Bird and the estate director of J Vineyards, Nicole Hitchcock.
For us at J Vineyards and Winery, we are female-founded, female-led, and we really have this legacy of female leadership in the wine industry and even beyond. And so we found a like-minded partner in the Golden State Valkyries who really joins us in our commitment to support all of the talented women out there across so many different industries. And as partners, we're showcasing that women's sports are a powerful vehicle for promoting broader cultural change.
Nicole, this is the first year that you guys have been having a formal partnership, I should say, with the WNBA. Do you anticipate that you will see not only a greater uptick in the awareness of your own wines and brands, but more importantly, better symbiosis, I guess, between both of those worlds?
That's right. I mean, our goal is to showcase the power of diversity in both industries, truly. You know, when we look at the wine industry, women are underrepresented as winemakers. Less than 20% of California's wineries have women as lead winemakers. And, you know, progress has been made over the years. I've been in the business for the last couple of decades, but we still face so many challenges because it comes to gender bias. And so we really are seeking broader leadership representation. And I know that there are similar stats in the sports industries as well.
And absolutely. And J Vineyards, of course, has been doing this for quite some time. And of course, the founder, Judy, and everything that she did to really sort of create that brand awareness and, more importantly, greater awareness about diversity. And Sue, you've been banging this drum for quite some time, not only in the alcohol and spirits space, but in other places as well. How did you and Nicole actually hook up here? I mean, is there a formal relationship, or are you just doing this because you love wine and you love what she makes?
All of the above. I think, you know, obviously played in the WNBA for a long time. This is the world of women's sports that I'm really passionate about. But I've seen a lot of, you know, some of the hardships that we faced. And then in connecting with Nicole, we met at officially at actually a Liberty Valkyries game, which was a lot of fun. But just really getting to know her, getting to know J Vineyards, what they've been doing, what they're about. There really is so much connection there. We're speaking the same language. And I think when you're doing that, Not only can you have, really value-based missions, you can also have good business. And that's what's really great about this. Yes, we're going to change some things in the world. I mean that quite literally, but it's also going to be a good business move.
It's interesting you say we're speaking the same language. It's also kind of interesting too, Sue. I mean, you have also kind of made this fun. I mean, I think back to the pandemic and the wind down that you were doing with your partner back in those days. But there's a lot of other podcasts and other sort of media properties that have popped up in the wine and spirit space that I do just speak a much different language. It sort of demystifies what wine is, the terroirs and everything that goes into it. And it does just make it a lot more fun. And I am curious as to how you keep that going, Sue, to sort of just let people know that this isn't, it's not just, about being a wine snob. There's a lot of fun in this as well.
There is. I think that's the beauty of it. You brought up my partner, Megan Rapinoe. She's getting so into wine. We're talking like regions and grapes. And I've broken my nose 5 times. And my palate's just not the same. I can't smell the things. But it doesn't mean we can't enjoy it all the same in our unique ways. And as an athlete, former athlete, I do drink wine. I do enjoy wine, obviously, in a responsible way. So there's also a messaging there. But really, when I was talking about speaking the same language, it's kind of having these worlds collide and understanding, just how hard it is for women and how wonderful it is to have, both Jay Vineyards, Golden State Valkyries, myself, the WNBA at large, being able to try to put a dent in some of these numbers, right? Like Nicole mentioned some of the numbers in terms of winemakers, female winemakers. The same thing happens in sports. I think, young girls and women play close to 50% in terms of participation in sports. We're close to 50%. Yet we only get, 16% of the media coverage. I know the percentage is somewhere in there in terms of corporate sponsorship. So that's really the same language. We're kind of fighting the same battle. And then, we can join forces, create really good business and have fun doing it.
With regards to that business, Nicole, I mean, how is business overall right now? I mean, a lot of anecdotal evidence that maybe the younger generation doesn't drink as much as the older generation. Is there sort of a shift that you're seeing that you have to adapt to as a winemaker?
I think that this generation is all about lifestyle and experience. And so part of what we're trying to do with this partnership is bring some of that excitement and experience to the table, of course, along with our delicious wines. But, wine can mean so much more when you enjoy it with people that you like and doing activities that you love, like watching a basketball game.
My conversation earlier today with basketball legend Sue Bird and wine legend Nicole Hitchcock as we close out the show on the day and on the week with a push ahead to a very busy week for investors up ahead. It's going to be dominated by earnings, including the kickoff of those big bank earnings. JP Morgan, Citi, Wells Fargo, all set to report, as is Netflix. So you'll get a read not only on the banks, but to a certain extent on the consumer. We're also expecting to get an update midweek on the consumer price index. Obviously, a big focus on inflation, given all the concerns about tariffs. We appreciate you joining us here on The Close. Stick around. The team at Balance of Power is coming up next for all your political coverage right here on Bloomberg.